Hey everybody, welcome.
Morning, everyone. Morning, Caroline. Morning, Paul.
It usually takes about 30 seconds or so just for the room to fill up.
All right. And then hopefully these guys came armed with their best and trickiest questions, and we can go from there.
Okay.
What I'd like to do is after we get through the questions, I'd like to do some work on choosing a volatility target, which I think is a really worthwhile exercise.
Fantastic. Okay, then. So the room is filling up. So if you'd like to text the text function, so you could pop your questions into the text function. Scott, you taking hand raised as well?
I don't know, man. I'm an idiot. You tell me what I'm doing. You tell me what I'm doing, bro.
Okay.
It's 6 a.m. I'm answering the questions that are posed to me.
You're our idiot, though, mate.
Yeah, exactly. So, exactly. So you won't find a better idiot.
All right, fantastic. So if you'd like to raise your hand, you can get on the microphone with Scott. Otherwise, if you'd like to pop your questions in the text chat, this is an AMA, so we're not effectively here to present to you. Scott is here to answer any questions that you might have.
Yeah, this is today. Today is without the sales bullshit. I'm just, so the purpose of today and my purpose of being here is I want to make sure that you guys know what you're getting into. I want to make sure that it's a good fit for you. And if it's not a good fit for you, you should be figuring that out before you get down the track with it. You know, we just want to be a bit honest about it, and you know, this is a really, really great product that we're really proud of, and you know, most of our competitive products are not. Most of our competitors are selling garbage or selling lies, and I personally don't like that. And it's natural that you guys think that, oh, we're another thing being sold over the internet. We're probably just like all those other things, but we're not like those other fucking things. And I'm anxious to give you the opportunity to prove that for yourselves.
Maybe we might have to switch it around and start with the volatility. Okay, we've got somebody. Hello, Sam. I'm just going to turn on your microphone.
Morning, Sam.
So there we go.
Hello, hi to all. I'm in Toronto, Canada. I've been following Scott's webinars, etc., trying to wrap my head around everything. And in the webinars, I mentioned to write down specific goals. I do have specific goals, and my first one would be to achieve 10,000 USD per month passively.
Okay. So let's talk a little bit about how that can be done passively, and what sort of money you would need on average to do that with a significant buffer, because the important thing to understand about returns is that costs are highly predictable, but returns are highly unpredictable. So it's unlikely in the extreme that any trade, and I mean any trading product, produces 10,000 a month in passive income like a salary. That's not the nature. It's far more likely that it earns 30,000 a month for you 3 or 4 months a year, gives back 5,000 for a couple of months, does it again, does nothing for a couple of months. That is the very nature of trading returns. And the reason this is so is if you understand this, it'll go a long way towards understanding trading. There's two ways to make money out of trading, and only two. One way is to know something that everyone else doesn't know, to get some insider trading knowledge, to get, advanced notice of an SEC thing, or you've got some economic data that you believe is predictive that no one else has, and you're the smartest guy in the whole world. If you're that guy, well, I'm not that guy, and you're not that guy either. So let's fucking grow up. The other way you can make money out of trading, if you're not pretending to be an extra on billions, is you can take risk, and you get paid for taking risk. And if I was to tell you, you can either get let's say you can get whatever you can get in the bank. Let's say you can get 5% in the bank right now, or you can have a chance of getting 100%. The first question is, well, what chance? How certain is it?
Right.
How much and how steady and smooth is it? And you look into the details of any return stream that comes from trading or investing, or, you know, stock market goes up most years and then shits the bed every 10 or 15 years. Real estate does the same every 25 years. You know, all of these, every sort of income return stream that you're taking risk and you're getting paid extra because you're taking that risk. Now,
Right.
when we try and separate out the risk that we're taking from the result that we're getting, oh yeah, I want to get 100% a year, but I don't want to take any risk, and I don't want it to be steady and smooth. Well, then we're in the realms of you got to grow the fuck up, because life isn't like that. There is no one who's going to pay you, you know, to sit in a hot tub and eat a pizza while you're getting a blowjob. If you want that experience, chances are you're probably going to have to pay someone for it. You're not going to get paid for it. So this is where we're at. What we're doing is we're betting on every trend that starts to form. Now, the reality of betting on every trend is that most of those trends will peter out before they become anything big. Every now and again, you get one that runs away and runs away and runs away, and that's what makes us all our money. So if I look at things right now, you know, what's going on in Bitcoin, for example, you can see that right here, Bitcoin was doing nothing here. And then right here, we started to accumulate a small long position. We increased that position slightly. We increased that position slightly. We increased it again. We increased it again. We increased it again. We increased it again. And now we're butting out against our max position. If this trend continues up, we're balls long on Bitcoin. Like, we're very, very long. If this trend reverses, we'll get out of it pretty quick, but we probably won't make much money for this big trade that we've got open. You know, we've been long Bitcoin since, you know, 26 and a half, probably an average price of a bit over 27,000. Bitcoin's 30,000 now. We've got a nice profit in there. That profit, if it goes up, we're already max position. So that's going to be great for us. If it goes down, well, we'll probably give back probably half of that profit before we're out of it. Now, which one of those two things is going to happen? I don't know. Like I legit don't know, and nobody knows. And that's the thing. The people who tell you they can predict the price, boy, it seems like it's easy to do, but like, that's bullshit, man. You know, the best we can do is observe and say, you know, if you look at this chart, you want to be long or you want to be short? Today, I want to be long. Why? Because it's gone up, mostly. If we pick another chart, like let's have a look at the things that are going down. ADA, I hate that bucket of shit. I've got friends who've they were convinced that ADA was the one. They dumped, you know, refused to buy Bitcoin, bought ADA instead. And, you know, let's look at the last year of ADA. What a fucking terrible thing to invest in. So if we look at them, ADA we were slightly short on ADA from here. So we've had a pretty good run, still short here. If ADA keeps going down, well, we're short and we'll make a lot of money. So we're -10, which is half of our maximum short position. If it reverses up, we'll continue to dial back our short position and we'll get out of it with a small profit. So so the game for us is we're taking many small profits and small losses, many of them. And those are relatively random. Like we've got the best of this one. We bet that it's short here, but it could reverse and wipe out our profit. And, you know, here, you know, we had a pretty decent trade, but nothing to write home about. But one day we'll get a really big move. And when we get that really big move, up or down, then we really make a lot of money. And that's all we're playing on. If we think about the central propositions of markets that we can rely on, one of the really big ones, and there's only about 4 things that you can rely on. is that every now and again you get a move that's so big, you go, holy shit, wow, never thought it'd go that far. Now, in our experience, we get more of those than you would expect if you were looking at a bell curve of market distributions, and markets were normally distributed, which we know they're not. Nassim Taleb proved that. Every now and again, in the tails, in the outliers, we get some weird shit happening. We get a COVID 2020. We get a, we get an altcoin bull market in 2021 that's just like 10 times as strong as anyone could have predicted. And if you look at the guys who actually predicted that, if you look at them, really, they predicted, they predicted 10 of the last 2 booms, or they predicted 10 of the last 2 crashes. Those prediction monkey type guys, they tend to make a mess of it in the long term. They get one right. For example, the best example is the guys in that Big Short movie. None of those guys who are like folk heroes now in the Big Short movie, they predicted 2008, have made any money since then. You look at their predictions now and they're just retarded. The guy, Michael Burry, he's continually deleting his Twitter tweets because it's like the shit that he's predicted just hasn't come true. And that's the nature of prediction. So what we're trying to do is move away from prediction into seeing things as they really are. What's going on with ADA right now? Well, it's going down. And so we should bet that it keeps going down. What we're not doing is going, well, ADA has this guy as the developer, and this is their roadmap, and this is their unlock schedule, and this is the things that they promised. And I think this is an Ethereum killer, and it is for this, this, and this. As soon as we get down into the weeds with reasons, I'm already starting to become a retard, right? I'm already getting stupider even the very minute I start to think about having reasons for things, because implicit in that is me thinking that I know better than everyone else. And, the evidence is clear. I don't know better. I'm not smart enough to predict the future, and no one is. So.
Scott, I don't mean, I'm understanding what you're saying. And one thing I forgot to add, I'm 70. I'm on a timeline. Does that do anything?
This definitely does change things. All right, so let's talk about timelines as you're changing. As you can see the finish line, you need to be getting out of riskier investments.
Right.
This is a risky investment by definition. So this should not be for you unless you are behind where you need to be to meet your retirement goals. And the goal for you, sir, I might gently suggest as a 70-year-old man, would be to be able to do whatever you want for as long as you live. And as
You got it.
That's the goal. If you are there now, this product is not for you.
Right.
You don't need to. If you can get there on 5%, which you can get in the bank right now, take that.
Yes.
Because if you've won the game, you should not be playing the game once you've already won. You get to, if you are behind, this becomes viable. If you are not behind, if you are on track to do everything you need to do, and you should be enjoying a rich and full retirement, this is not for you.
Right. Yeah. No, I hear what you're saying. I have a good life. I'm not complaining about that, but I want to get to the point that you just mentioned. Do whatever I want to do whenever I want to do it. Like if I want to drop right now and go somewhere, I want to be able to do that. I don't want to have to think about it. I just want to go.
well, that's actually what you deserve. I mean, I'm assuming you've worked hard your whole life, and it's a fundamental injustice of society if a man works his whole life and can't just decide to go on a holiday somewhere. Like, I'm not talking about buying Ferraris or private jets or shit like that. I'm just talking about like just doing whatever the fuck you want. Like that should be your birthright now.
Right. Thank you.
You're welcome.
Brilliant. Thank you, Jeffrey. Jeffrey, Sam. The next question is from Jeffrey. So I had that on the brain. I think you'll like this one, Scott. So Jeffrey's asking, does Finrev take account of implied volatility?
Very, very good question. Okay, so I'm going to get a little bit nerdy here because I love this. Implied volatility is the volatility that's implied by the current options market for people who are buying and selling options. Realized volatility is the volatility that actually happens. Now, people who sell volatility are selling insurance policies. They're selling crash insurance. Crash insurance is no different than selling car insurance or house insurance or whatever. The person buying the insurance does not expect to make a profit on it. If I buy house insurance, I'm not trying to make a profit on it. I'm not trying to say, oh, in 30 years, I would have been better off without it. What I'm trying to save is if my car gets stolen, I just don't want to have a bad day. And so it stands to reason that the person selling me that insurance would only sell me that insurance if they were planning on making a profit on it. And they wouldn't be party to the transaction unless they were making a profit. So implicit in the difference between implied and realized volatility is that historically, over the last 100 years, the first time this phenomenon was mentioned in an options book was in 1885. And this is as close to gravity as you can get in the financial world, is that implied volatility, realized volatility tends to come in under where implied volatility tells you. In other words, that generally selling options is a thing that makes profit. Selling insurance is a thing that makes profit. So to answer your question, no, we don't use implied volatility. What we do use is a blend of two different let me explain our volatility forecasting model. So every day we take a forecast of our position of our we take a forecast, which is our signal strength. We multiply that with a volatility forecast. Volatility has two defining characteristics. The biggest predictor of what tomorrow's volatility is going to be is today's volatility. Volatility stays the same in the short term, and yet in the medium term, volatility is probably going to be what it is. It's going to revert to the mean in the medium term. So we have these two competing ideas. Mostly tomorrow's volatility is going to be pretty close to today's volatility, but it does long-term mean revert. So we blend a 70-30 blend of the last 30 days realized volatility and a longer term volatility, which is 100 days. So that's how we calculate our volatility forecast, and that gets us, when we started off doing just the last 30 days, and that got us to a 95% prediction rate, and we're at 98% realized volatility prediction. So for us, realized volatility is a much more accurate predictor of tomorrow's realized volatility than implied volatility would be. Sorry for the guys who don't get nerdy about stuff like that, but I like those questions.
That's really great. So some people were asking about exchanges. So we just mentioned that we're bringing BitGet on, as that is the next one on our roadmap.
Yeah, I want to address that. So this is an ongoing problem in the US. You know, at its heart, we're doing the SEC regime at the moment, until it changes, is fundamentally against crypto, and they're doing everything to make crypto a really ball ache for US customers. There's some ways that we can go around that. So what I'd like to do is have a backup plan of having a spot exchange, like a Coinbase or a Kraken. Probably Kraken will be the next one that we add, so that we don't just have to stay with the no KYC derivatives exchanges. And the next thing we can do is a DeFi exchange, which literally can't be stopped by the US government. So that's our upcoming roadmap. Yeah, it's a pain in the ass for us. I'm not going to lie about that, but we're well ahead of it. Like this is our whole life, is staying ahead of this for US customers.
Absolutely. So here's an interesting one from Jaguar. The Finrev charts could be used as predictive indicators to do extra crypto trading.
Okay, this is a very interesting thing. So let's talk a little bit about the nature of trends and sigmoid functions. So there we go. That's a sigmoid. So if you think about the moment when you got fucked most by crypto, it's almost certainly right when all your mates are calling you about how do I get into crypto, like a 2018 or like a March 2021. If we just go on our signal strength is very, very strong here. The moments when we get fucked are the moments when we're most bullish, the bull market looks at its most strongest right before it shits itself. And also, if you think about the bear market that just ended, we weren't really clear until we were past it. But at the moment of maximum bearishness, when was the moment of maximum bearishness? It was like this day. It was when the SEC started enforcement against Binance and Coinbase, right? So this day, the moment of maximum bearishness and the moment of maximum bullishness, those are things you want to avoid. And so we avoid them. The standard way this is done in quant finance is with a sigmoid function. So we don't want to keep getting our signal strength stronger and stronger and stronger and stronger and stronger and stronger. We want it to taper off at the extremes. And this is what we do. So if we say that right now, we say a -10 is a normal short position and a +10 is a normal long position. We want to cap this at -20 and +20. This is how we do it. So what we want to avoid is the situation where we're in a super, super strong trend and we just bet the farm on it and keep compounding down into that and keep doubling down. Because what that guarantees is if it comes off, sure, we look very smart, but a lot of the time these trends, they start to go and then they reverse out and peter out. It's like, you know, like not every storm becomes a hurricane, but when they do, the hurricane is very strong, kind of thing. Does that make sense? Do you need me to flesh out any more parts of that?
That's an interesting concept. I think we'll keep returning to that. Scott, there's a really good question here from Frieden. Frieden, he wants to know why you don't just sit in a room by yourself and get rich off of this. Why have you built a business to want to share this with everybody?
Perfectly legitimate question, right? Like, okay, two reasons. One, my trading accounts in total are about $4 million. That'll get me to where I want to go. That'll get me to where I want to go in 10 years. I don't want to wait 10 years. But the real reason is I was a retail trader. Well, I've been trading full-time since 2007, and I got ripped off and misled by some of the biggest names in trading, like that I thought were legit, were going to teach me how to do this. And I really only figured out, you know, what I consider to be like high-level quant trading in the last 2 or 3 years. Before that, I was a guy who struggled. And if I look at all the things that my retail trader friends still believe in, most of them are wrong. And I thought I was a very good trading system designer, to the point where I'd release courses on trading system design. And having gone through the process of building this, I now realize that I actually didn't know shit. And I was substantially wrong about many aspects of things that I was really certain I was right about. You know, things like stop losses, for example. Stop losses are generally a cognitive mistake or a position sizing mistake, and they make trading systems harder, not better. Now, if you had told the 5 years ago version of me that, I would have said, no, that's bullshit, man. You don't know what you're talking about. So for me, I feel we have a responsibility to share this. And the real reason is I used to think that people should trade. I used to think that trading was a skill that everyone should have. And I remember when I met Ian teaching you how to trade, like, bro, like, this is something you need to know. I no longer think that. I no longer think that little guys like me should trade. I think that we should either put it in a fund, just buy, if we're talking about stocks, just buy the SPY. Bitcoin hodling, if that's your thing, but this is better than all of them. but I don't think that retail traders should actively in and out trade it. Like, and I know how much fun that is because I've done that, for years and years and years. I know how much fun it is, but I also know that the things in my life that are really fun, I have to pay for. And the things in my life that I get paid for are kind of boring. And this is the kind of thing that I get paid for. It's a better, honestly, I've got a great friend who I'm seeing him on Friday. 2 times now, he's taken an account from like 10 or 20 grand up to over $1 million and then back down to like 100 grand. And he told me the other day that he's just hoping he gets a third chance. And that happens to pretty much everyone who tries to discretionary trade their own things. Like at the right time in the right bull market, you can be a bull market genius, but try and keep hold of it. Good trick.
Yeah, it really is. And we've got a second great question from the same person, Freedom. It's a concept question is how they phrase it. What about privacy coins such as Monero, Pirate, etc.? Privacy exchanges like Trade Ogre. Any preference for that or just cryptos in general?
Okay, so I personally want to have a threshold for what's my threshold for me having an opinion. There are certain things that, every asshole has an opinion, but sometimes there's only one asshole squirting it, right? I don't particularly want to say that I can have a valid informed decision. I was big on privacy coins like 2018. Like I thought privacy coins are going to be the real thing, but that just hasn't been the case. I'm sure they've got fine qualities, but if we look at all of these, what I'm trying to do is not have an opinion. Philosophically, what I'm trying to say is that I'm not smart enough to have an opinion. Like and to admit that I'm a sucker for a story because I'm a human being. When I hear someone say, well, there's all these problems with the US government trying to fuck with people and surely a completely privacy focused coin would appeal to those people, I'd say, yeah, that sounds really fucking plausible. Like that actually sounds legit to me. But then I also go, forget about all the things you that sound plausible to you because you're an idiot, Scott. Like you don't have the right. I don't have the intellectual horsepower to have an opinion about hundreds and hundreds of coins. I've got to treat it as though I'm a moron. And I've got to say, well, of all these coins here, which ones do I really know about? I got a pretty fair claim to knowing about Uni. I know that TRX is a scam. I know that Waves is a failed project. I really like Woo. Stellar Lumen's dinosaur coin. ZRX, that's got to be a failure. But if I look at the ones that I'm absolutely certain is a scam, like I'm certain TRX is a scam, well, fuck me, it's done pretty well for a scam, right? Like my opinions are going to get me into trouble more often than they save my ass. And for the home user, your opinions are going to confuse you. I think it's a scam coin. I think it's a scam coin. Why is it going up? Oh fuck, I was wrong. Maybe it's not a scam. And then you get fucked. And then, let's look at TRX over the last.
And it can become easy to fall in love with a coin as well.
Oh.
I'll just hold it a bit longer, just a bit. It's
well, the worst thing that can ever happen to you, falling in love. It's worse than falling in love with a stripper. Oh.
It's not realized till you close the position, right?
Oh, promise me you were the one. Like, and I mean, TRX for the coin that this is a slam dunk scam coin. It's done pretty well. It's done better than most for the last couple of years. It's held strong. Our system today is long, 13 out of a possible 20. We're long, and we've been long since, since March. I mean, I could never have got that right. Like in a million years, if you told me that Justin Sun's, it's an obvious Ponzi scheme, he's an obvious scammer, like he's clearly a beady-eyed little in cahoots with the Chinese government sort of a guy. Fuck that guy. I wouldn't have picked it in a million years. And look, the other one that happened last week, have a look at this. Bitcoin trash. Like this is a failed thing The last 2 years it has been Bitcoin BCH failing and failing and failing because they came at the king Bitcoin and they missed. And then look at it right now. So we get long here. We stay long here. Long, increasing our position size. If this was you as a discretionary trader, at what point did you start to admit that Bitcoin BCH has some legs? Probably only about here. It's a bit late. You're a bit late, buddy. You know, so what this gives us, it gives us the ability to set aside our emotions. Now, when you trade with emotions and a system, you're in danger of getting the worst aspects of both things. You're in danger of getting a non-systematic result, but you're also in danger of your emotions getting you the wrong result. Like, so really what I think that everyone should do is trade to a fixed set of rules. You know, whether they're my rules or someone else's rules, my rules aren't the be all and end all. I can give you a set of rules that approximates this. Buy everything that's making that closes at the highest price in 50 days and short everything that closes at the lowest price in 50 days. That will get you 80% of the way here and you don't have to give me a cent. Wake up every day, everything that's at a 50-day high, buy it. Everything that's a 50-day low, short it. That'll get you 80% of the way towards this. But congratulations, you got yourself a new and shitty and terrifying job. Good on you. Now your life sucks. But that will get you the similar kind of result.
Good. That's usually around the time that you get like more apps on the phone so that you can just remain connected to the discretionary trade no matter where you are or what you're doing. And yeah, like you say. Now, there's a nice seg here, Scott, into a question that Mark Law has asked. I'll just set the context for the people in the room and then hand it over to you. So Mark's question is, so will CSI keep going or just let Finrev do the work? So just to set the context, CSI is our income generation system, crypto salary incubator. So I'll hand that to you now, Scott.
So this is a really good question. And let's answer it with honesty. These are typical returns for Finrev system, going sideways for a long time, and then popping up, sideways for a long time, popping up, sideways for a long time, popping up, sideways for a long time, popping up. We're doing really good right now. Now, is that suitable for paying your bills on time every month and counting on it like clockwork? No, it's fucking terrible for that. Absolutely the worst thing in the world for, I need to pay my mortgage next month. I better rely on Finrev. Finrev will reliably double you on average every year, but that's not the same as next month. So I would use both. Finrev is CSI is a job. CSI is a job that you get paid for sitting down at the computer and spending a couple of hours doing a thing. If that's a suitable rate of pay for you sitting down and doing the job, and in the real world, for me, what it's worked out at after you strip all the fees and all the bullshit around is it works for every $10,000 that I have invested, it works out at about $50 an hour. So it's now if I put 100 grand on it, then I can earn $500. Then I can earn $500 an hour. Is that a great rate of pay for me? Not particularly. It's a medium paying, kind of boring job. That's what CSI is. It's a medium paying, boring job. That's far more consistent and reliable than Finrev is, but also a lot more work.
I'll just add to that, Scott. So, you know, our coaches, they still love trading. They trade every day. So it's still something we're very passionate about, and we do both. And the reality is, Finrev is kind of like your I need to grow up financially strategy. Let me do something a bit more stable and conservative that's for the long term, and then still have your money that you trade.
It's boring. And most people, if you tell them, eat chicken and broccoli every day, we know that if you eat chicken and broccoli every day, you'll have a good body and blah, 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 and you'll have a six-pack. But no one wants to do that shit. Like I've traded trend following for years and years and years in the traditional finance markets, and it's so soul destroying. Like, there's a reason why no one wants to do it. You want to let Finrev handle this aspect of your life. The other aspect of your life, that's all like blowjobs and chocolate and treats. Like, yeah, enjoy it. Make it a smaller percentage of, make it a smaller part of your life, and really, really enjoy it. Trading is fun. It's especially fun when you're winning at it. And CSI lets you win at trading, and there's very few ways that actually do that. CSI works on carry. So carry is a signal based on the amount of money that you earn if nothing changes. So if you get paid an interest rate in the perpetual futures just for holding that coin, we're just monetizing that phenomenon. It's not controversial. It's not even difficult, really. It's just a carry trade.
Excellent. Okay, so this might be a good time to seg into the volatility presentation that you wanted to do, Scott.
Sure. So let's talk about that. Now, when you get set up with Finrev, you have to choose a volatility target. Now, what that volatility target is well, let's talk about what it is. You can dial it up to very high returns and high drawdowns, or you can dial it down and have it be more certain. Now, if I was to ask everyone in this room, like, what do you want? And right now, you're all going to say, I want the most amount of money. I want to crank it to maximum. And let's just go through how that really is in reality, and then we'll see if you still feel the same way. So what I think is that helping our customers succeed, it's a duty we take seriously. And now my obligation is to help you make the right choice. So what's the right choice? The right choice is the choice that helps you succeed. And what is success? Everyone's different. Everyone has a different risk tolerance. Some people have giant balls. I'm very used to big swings in my net worth and highs and lows, and I'm very used to that. So that doesn't bother me. People have different incomes. If you have a higher income, you can afford to take more risk because you've got an income that's higher. People have different asset mixes. If you have stocks, you want something that's not correlated to stocks. So crypto is very, very advantageous. If you've got real estate, you want something that's not correlated to real estate, and crypto is very, very advantageous for that. Everyone has a different need and a goal. Like some people are I gonna get to $100 million, and I'm not that guy. I know my number. My number is $20 million. When I get $20 million, I'm dropping the mic. I'm out of the game. I'm at 4 now. I'm plus whatever my business is worth. I'll get there within a couple of years. But once I win the game, I'm out of the game. That's a big mistake that I made once before in my life, is to keep playing when I won. Everyone has a different time to retirement. If you're young, you can take more risk. If you're closer to the goal, you've got to dial that risk down a bit. And some people already have a different this asset stream is non-correlated to crypto. So if you've got some hodling Bitcoin, it's very advantageous. So there's no point in having a plan that in theory maximizes the investing returns if you can't stick to it. So doing this for real, it's really different than doing it on the sidelines. Like it looks easy. It is hard. And everyone can look at a chart of 2008 and say, oh, I would have bought there. And I was there and I didn't buy. And I was terrified. And all the pros I knew were terrified that day. So you think you're going to be able to do a thing, but when money talks and bullshit runs a marathon, you'll find that it's very, very hard to do. So if we give you a plan that you can't follow through when things get hard, you get the worst of all possible worlds. You don't get the advantages of systematic trading because you couldn't stick with the system. And they also get the worst disadvantages of discretionary trading, which is you're going to be an emotional little bitch right when you need to be a chess player. Trading decisions based on emotions are rarely correct. This is a truism that we've all felt. So the plan has to be realistic enough that you can stick to it. It has to have a high probability, and it starts with a clear goal and a realistic plan. Okay, so my mission for you guys is you probably do have enough if you compound at a high rate. And the really important ingredients in this soup are compound annual growth rate and time. And the problem is that large drawdowns really, really hurt compounding. So if you have a 50% drawdown, you need 100% just to get back to square. And this drastically makes the compounding game harder, because the only thing that matters is what do you start with and what do you have at the end of the game. Everything else is just all bullshit. It doesn't matter what it does along the way. What matters is what did I start with and what did I get at the end? Nothing else. So if we're doing 30% a year, which I think is very, very overly conservative, start with 10,000, we're at 37,000 by year 5, and by year 10, we're at a 13x. At 50,000, we're at a 33x. At 100%, so if it's done historically as well as we've done, it's got these ludicrous numbers, 320,000, 10 million. Like, those things sound ludicrous to me, but that's maths. That compounding works. This is the way it is. So how should you do your financial planning? You shouldn't count on this. You should add a fair margin for safety. What's a fair margin for safety? Probably 70%, 50%. I would say 50% is a fair margin for safety. And so, okay, if I'm putting in 10,000, I can reasonably think that will 33x that in a decade. That's pretty good. We need to cover some foundational concepts first. We need to understand volatility, Sharpe ratio, and excuse me, these are nerdy concepts. I'm going to go over them quickly so I don't get bogged down. So volatility is the amount your account wiggles. Wiggles a lot, high volatility, wiggles a little, low volatility. Big difference between professional and amateurs is amateurs think about how much money, what was that percent was our return, whereas professionals say, well, what was your return divided by your risk, which is your Sharpe ratio. So risk is what you buy return with. That's the way to think about it. Risk is what you buy return with. We're getting paid for taking risk. We're not getting paid for being right. We're not in that game. We're not the guy off billions doing insider trading. We're not the high frequency trader who gets his information a fraction of a second before everyone else. We're not in that game of knowing stuff first, fastest, the smartest. We're not the smartest. What we're doing is we're getting paid for taking risk, which is mediocre, but it's more sustainable and it never goes away. So what is Sharpe ratio? Sharpe ratio is just the way that professionals measure DICs. And the easy way to think about it is returns divided by risk. And it's invariant to leverage. So if it doesn't matter what leverage you have, mild or wild, the Sharpe ratio remains the same. So a trading system earning 20% per year with annualized volatility of 10% has a Sharpe ratio of 2. Trading system earning 40% per year with the volatility of 40% has a Sharpe ratio of 1. And you can see how it makes comparing things kind of confusing, because a bond fund earning 8% per year with 2% drawdown actually is a better investment technically than buying Bitcoin back in the day, or a trading system that makes 50% a year with 30% drawdowns. So what's a good Sharpe ratio? So let's look at treasury bonds, buy and hold stocks, any sort of single instrument strategy. They top out at about 0.4. Old style trend following 0.55 to 0.7. Warren Buffett 0.76. Bitcoin on a 10-year hold, 0.81, Ray Dalio, 0.9, George Soros, 1. So this is about the range of normal shit that's really good. Volatility targeted trend following, like TransTrend, like Man AHL, like Winton, they've all done between 1 and 1.2. This is what we're doing, but on crypto. So the Finrev system, we've done historically 1.81 Sharpe ratio, and that's not because we're any better than these guys. It's just because crypto is a newer and riskier and more inefficient market. There are people better than us. Renaissance Technology, you can't invest with them. High frequency traders rarely have a losing day. We're not playing that I'm first, I'm smartest game. Where are we? We're about as good as we can be for the game that we're playing. And we're intentionally choosing to play a game that's not a difficult game, a game that we're unlikely to lose at. So if we look at what's a good Sharpe ratio, these are some of the best hedge funds of all time. Windsor, 13%, Berkshire Hathaway, 25 for his best decade. Quantum was George Soros, 22, Tiger, Julian Robinson, 17, and the Ford Endowment Fund is actually one of the best managed hedge funds ever, 14.5%. Harvard University, 15%, S&P 500, 18% in this good period. Treasury, 7, UST bills, and inflation, 3. So, you know, we see the range of Sharpe ratios of 0.6 to 1, 1.15 to 1 in a good period. So anything above 1 is great. So Sharpe ratio isn't without its flaws. It penalizes upside volatility, which is what we have, and it doesn't take into account skew. So skew is trend following systems have positive skew, meaning that if the world shits the bed, trend following does really well. If Bitcoin crashes, trend following does really well. This is extremely desirable for investors for obvious reasons, and Sharpe ratio doesn't take into account that. If you were faced with the choice of a negative skew Sharpe 1.5 system and a positive skew Sharpe 1 system, you might well choose the positive skew system. Positive skew systems are armor plated. They're very difficult to go broke with. So positive skew systems go sideways for a while and then jump up quickly, and they kind of feel terrible, but they're more reliable. So you can see that positive skew systems go sideways, then have a big jump up. Positive skew systems can be traded at a higher risk target without risk of ruin, and they work best in surprise regimes, runaway bull markets and surprise bear markets. So if we're looking at, this is a distribution of trades, over 1,400 trades, this is in the traditional finance markets, this is a break-even trade. So we have quite a lot of losing trades, an enormous amount of break-even trades, and a smaller number of winning trades. And of those winners, 3.2% are 5 baggers or better, 5R or better, and only 0.9 of 1% are 10 baggers or better. So it's really only this 1% of trades that make all the money. This is the distribution that is safest. Why is it safest? Because we're not betting on direction. What we're betting on is that the existence of outlier things. So what we're betting on is that there's going to be rug pulls or moons in crypto markets. So we're betting that more coins than anyone predicts will be complete scams, or more coins than anyone predicts will be 100x moons. It's called positive skew because our bell curve is skewed to the right with more winners and our losses small. We can do the other way, negative skewed, with higher win rate, but with a nasty left tail. That's not a smart idea. So negative skew systems make money consistently and then fail when you need them most. So this is carry, which is another type of negative skew system, which we're going to add to the system, but it makes money very consistently and then shits the bed. It makes money very consistently, shits the bed, makes money very consistently, shits the bed. These feel good to trade, but they hurt when it hurts you to get hurt. That's why we didn't start with them. We're adding this now. So negative skew systems have a high win rate, but no big winners. So they're 65, 70% winners compared to the 45% that we get from trend. Negative skew systems are generally convergent. They're traders who have a model of the world, and when things depart from the model, they're trading mean reversion to that model. And they're analogous to selling insurance that traders call these insurance-like characteristics. The optimal strategy is what we plan to do with Finrev is you can see this gray dotted line is negative skew systems. They make money consistently, then shit the bed, make money consistently, shit the bed. Positive skew systems are the red dotted line, like we've got now. They lose a little bit of money, then make a lot of money, and then lose a little bit of money and go sideways, then make a lot of money. The optimal strategy is combining the two into the green line. Finrev, as it is now, is all about survival and success. Negative skew systems are about feeling good, about satisfaction. When we combine them, we get something like this, which is the intersection of survival, success, and satisfaction. So, summary so far, Sharpe ratio is a way of comparing risk-adjusted returns. Everyone has to choose a volatility target. The right target has a high probability of getting you what you want, and it's something you can live with. Okay, so Kelly criterion is a mathematical formula that lets you choose the optimal position target. It's slightly different for positive skew systems of this dotted line and negative skew systems of this dotted line. So we can expect to make more money with a higher risk target up to a certain point, and then where our expected return goes down. Why is this? Because a 50% drawdown needs 100% to just to come back to, and that becomes a hurdle that decreases your odds of winning over time and increases your odds of blowing up. So yeah, so this curve is for a sharp 0.95 system, which is us on a traditional finance market. So I would not recommend. You can see that the optimal risk percentage is around 50, but by the time you get up to 60, you're going down. So full Kelly optimal position sizing on our system since 2018 was 57%. You might think that's the optimum, but it's not so simple. It's only the optimum if the trading system in the past is what it does in the future. Could do better, could do worse. We just don't know. Now, our worst case scenario should be that it does no better and no worse than any other market. Just like it does on equities or bonds or gold or whatever. In that case, I would recommend that the optimal Kelly target is 50%. That's going to maximize your long-term compounding. Now, what situations would someone want to trade a lower than optimal target? If you've got a shorter time horizon to retirement, like the gentleman who's 70 years old, definitely don't want to go full Kelly. If you've already got enough money, definitely don't want to go full Kelly. If you don't have a stable income, if you're doing some sort of internet side hustle, internet-y thing, adjacent thing, or if you've got seasonal income, if it's not stable, you don't want to bet as much. If you think I'm kind of a bullshitter and I've like over-optimistic everything, apply a margin for error, trade it at a lower. If you think I've got the flavor of bullshit about me, dial it back a bit. If you want to leave a margin for error, which is smart, dial it back a bit. Dial it back from 50 to 40 to 35. If you are a naturally risk-averse person, if you know that, look, I know myself, like me personally, I'm the type of guy that says, fuck it, let's risk it for the biscuit. Fuck it, we ball. That's me in a nutshell. And I've experienced both the good and the bad results of that in my life. Believe me, no one's taken more stupid risks and had them fail than me. If you are naturally if you're not like that, dial it back a bit. And if this is money you can't afford to lose, if you're fucked without it, well, fuck, dial it, please dial it back a bit. So when would you want to up it? When would you want to go a little bit more fuck it, we ball? If you're young, if you've got a long time to retirement, fuck it, you ball. Compounding wins. You know, a couple of extra percent in compounding, you do the math, it's millions and millions and millions retirement. If you've got a high income, if you're killing it in other areas of your life, you can risk it. If this is a very small percentage of your total assets, if you're a millionaire and you're talking about risking 20 or 50 grand, who gives a fuck? Then it's time to dial it up. If you think that the system will perform better in the future than it has in the past, that could happen. That could happen. If you have a very high innate risk tolerance, like you're a bit like me, if this is an insignificant percentage of your total assets, and if you can add more funds if things go bad, you can trade a higher than I would recommend volatility target. So let's look at some simulations. So we're going to use a simulator and we're going to spit out 10 equity curves for a system that performs like ours. We're going to dial that back about 20% and say I've been over optimistic. We're going to look at the best, we're going to look at the worst, and we're going to look at the averages. And you're going to, right now, I bet you every one of you think that you're going to take take the option that earns the most money. And it's not like that. So if we look at an 11% volatility target, which is ultra conservative, this is over 3 years. It's going to take 10,000 in a best case scenario to what? About 27,000. The worst case scenario is going to take 10,000 to 17,000. And on average, it's going to take it to 22,000. So this is an ultra conservative thing. And our best was 23%. Our worst was 11%, and our average was 16%. That's okay. Most people were relatively happy with that. And the thing I want to point to you is that there's not much difference between the best and the worst. With our ultra conservative 11% volatility target, this 18.6 was our maximum drawdown in the best case scenario, 13% in the worst case scenario, and an average was 8.2% worst drawdown. Like those are things that people can deal with. The drawdowns were still long. So going conservative didn't save you from long drawdowns, it saved you from money. Now let's up this to 15% volatility target. Our average return rises from 16% to 21%, while our worst drawdown goes on average from 8.2% to 15.9%. So ain't nothing for nothing. This is what I want to get across to you. Your returns have gone up, but your drawdown's gone up too. It's like, oh, fuck. Now, if we look at our Sharpe ratios, between our best was 1.9, that's amazing. Our worst was 0.9, still as good as fucking George Soros, still pretty good. And the average is 1.5, which is bang on what you'd expect. Now, if we look at the green curve is the lucky curve, the best of 10. Wow, who wouldn't want that? 10,000 into 350K, into 35,000, sorry. Tripled your money in 3 years. Wonderful. We still haven't got a significant difference between the best and the worst. Like they're big, but they're not like, oh, fuck. And so with these conservative targets, we get amazing, great, and good. You don't get amazing, great, and good as we go higher and higher and higher. The more risk you take, the more luck comes into it. And the key thing I want you to understand is that taking on risk is risky. There's very few free lunches in finance. If anyone's telling you you can get this without taking risk, boy, they're fucking bullshitting you, man. So taking on more risk means that you're more exposed to luck. Luck is working in your favor and against your favor. Lower risk targets are less difference between being lucky and unlucky. So let's look at 25% volatility target, which is about the minimum that I'd recommend anyone take. If you want to do less than 25%, crypto is probably not the market for you guys. Like there's probably, bonds are over that away, and you can get 5% off bonds now. So if we look at a 25% volatility target, well, the best case scenario, we're looking at 58% compounding. Worst case, we're looking at 13.2 and an average of 36%. That's pretty good. This is still pretty conservative, but you can see that the big distinctions between lucky and unlucky start to come. Now we go to 35% volatility target, which is where most of our customers are sitting. If you 35% volatility target and you get lucky, you're at 125% per year compounding, average of 57%, and a worst case scenario of 28. I can live with all three of those. And if we look at our Sharpe ratios, the lucky one is just incredible. Like no one's ever done that, outside of being lucky. Average is exactly what we'd expect. And the worst case scenario is still pretty good. So 50% volatility target. Now, this is aggressive. This is as aggressive as I'd recommend people getting. You get lucky with it, you get 164%. I can't count on luck. The average is 70%. And the worst case scenario, the bottom 10% of results, is 31%. Can I live? So the real question is, if I'm at 50%, can I live with the worst case scenario result? Is it worth worst case scenario 0.6 Sharpe ratio to potentially get that, and on average get that? This is an aggressive move. This is an aggressive move. So let's run this simulation again with a different set of numbers. And you see here, our average is 57%. Best case scenario, 157%. Worst case scenario, 43%. And we're looking at 3.3 Sharpe in a best case scenario. That requires luck. 1.2 on average, and 0.9 in the worst case scenario. Where are you placed? Like you can see that this decision is not so clean cut. So let's go up to 60%, which is past where I'm going to let you go. And let's see what happens. So our worst case scenario lost 5.8% a year, but the best case scenario made 301% a year. This is a shit go. This is what you shouldn't do. So tempting, right? Like if you do this, you're getting rich if you're lucky. If you're not lucky, you're losing 5.8% a year. No, this one's not smart. Mathematically, no, this one's not smart. You don't want to go this hard. So actually we don't have time here, but if you go to robotwealth.shinyapps.io, Ian, can you post this in the chat, please? This is our excellent friend James who built this. And if you want to run your own numbers, if you take your return percentage and multiply it by 1.52 as a volatility target, that'll give you the same simulations as we've used. So you can run your own. Now, here's a summary. This is the important part. Most people, with not all of their net wealth in crypto, they're going to run between 35 and 50%. The lower your vol target, the lower your returns, but the less difference there is between being lucky and unlucky. There's no luck isn't a big deal. The expected return increases to about 57% volatility and then decreases. If you keep increasing it beyond that, you face a very real risk of losing money until about 65%. And then beyond that, you're facing a very real risk of losing it all. Now, my advice, whatever target you think you can handle, size it down one. From XXL to XL, from L to M. That's just human nature is just, you know, we evolved for risk taking. Whatever you think you're good, just size it back. If you think I'm a little optimistic or I'm kind of a bullshitter or you think I've overestimated it, size it back a bit. The longer you trade the system, and this is important to understand, the more good luck and bad luck, they all even out. If you stick with it for 10 years, doesn't matter. Luck, you're going to have some bad luck and you're going to have some good luck. So how do you decide? So the range is 25 to 50%. Less than 25% crypto, you probably bonds are over that away, you know, buy and hold the SPY if that's for you. Fuck on out of here. 60%, very aggressive. I'd allow it for the right person, but I'd want to speak with them personally and they'd really need to understand what they're getting into. I'm at 50%. That's me. That has no risk of blowing up, optimizes my long-term wealth creation, slightly less than the mathematically optimal solution. And that might be hard to live with. Not for me, but for some of you, it might. And that's just being honest. You get nothing for nothing. If there's one thing I want to take you to take away from today, that this is a nothing for nothing world. You want more return. Oh, you take more risk. What does that mean? It means you might get punched in the face a little bit. That's what it means. If this was your whole bankroll, 50% wouldn't be cool. Unless you're very young or unless you had a high income or unless you were giant balls of steel. Whatever you think you can handle, size it down a bit. So for most of you, the range is probably going to be 35 to 50 is for most of you. Okay, so let's have some questions about that.
Okay, that was a great delivery there, Scott. So we're just over an hour in the room now. Obviously, volatility is a very big subject, but I think you've summed it up really great there, especially towards the end, that we do pick the volatility based on our own circumstances, and we're not going over 50 for really any reason at all, really, you know. So more in the sort of 30, if you're a bit more conservative, lots of the reasons that Scott mentioned, more towards 50 if you can be more aggressive with the volatility itself. So just while people maybe are formulating questions, Scott, I've got the link ready. Maybe you'd like to talk about what's the next step if people want to get involved with this.
All right. If you think this is for you, and my purpose here today is to show you, you know, without the sales aspect of things, I just want to show you how it is for reals. And if you think this is going to work for you, if you think this is going to help you get to your financial goals, and the gentleman who's 70 years old, I'd say think very, very carefully about whether you're up for this. You know, just get with our product enrollment team. It's at finrev.trade/intake. That's in the chat right now. This is the way that I recommend you trade and invest for the rest of your life. This has got the bulk of my net worth in it, and it's going to have the bulk of my net worth in it for the foreseeable future. This is, to me, this is the ultimate bulletproof strategy. You can get a strategy that's going to earn more in the right special, the planets align, the cloud, you know, the weather's beautiful. You can get a strategy that will beat it, but you can't get a strategy that's almost impossible to blow up. This is the unbreakable tank of trading strategies. So if that appeals to you, and it appeals to me, everyone in our team is passionate about it. Like, everyone trades it with their own money. the whole company from, the CFO and all the marketing guys, everyone has their own money in it. Like, this is shit that we really believe in. It's fucking cool, guys. Like, it's fucking cool. I showed it to James Hodges on the weekend, the guy who did those simulations that we looked at. And he's at, ex-Jane Street quant, worked for like the best algo trading firm in the world. He's like, holy shit, I can't believe you guys built this. This is amazing. And this is true. Like, retail guys should not have access to stuff like this. This is more like what you'd have if you're working in a hedge fund. So yeah, I reckon it's great.
Absolutely. And as you mentioned on the first presentation, generally stuff's like 100 grand or more to get into. So this really is the opportunity just for the average dude in the street to be like, I got a shot here.
So let me explain what we're really doing when you strip all the marketing bullshit away. Normal trend following applied to crypto works like 3 to 5 times better. That's what it is. It's not because I built the super system. We took the same damn system that every trend following hedge fund does. Exactly the same. There's stylistic differences, but we're within spitting distance of each other. And we know that because when we apply our simulations to the traditional finance markets, we do exactly the same as them. And they all do exactly the same as each other. But when we apply it to crypto, it's like, holy shit, this thing just blows the lights out. And why is that? It's not because I'm so smart at all. It's just because crypto is a less efficient market. It's a newer market. A logical, rational investor making the decision to be in crypto would want to be higher compensated. If you have the choice between crypto and stocks and they both pay the same, you're going with stocks. If you have the choice between, if you're going to invest in crypto, you damn sure want a higher rate of return to compensate you for the extra risk that you're taking. And all we're doing is monetizing that thing. All the bullshit that comes with crypto, the SEC, the exchanges, the SAMs, all that bullshit, we're monetizing that. There's extra risk. We want to be paid extra return, and we're just making sure that we get it. That's all we're doing.
Nice, really great. And so the link is there if anybody wants to chat with the enrollment directors, and anybody that chooses to come and join us. There's every chance that Coach Paul Candian might even do your VMP onboarding, because that's part of the, once you're with us, we take care of you and you get a human being at every stage of the way, and we get you set up. And that's the people all the way from, well, I don't even know how to get $1 into crypto. We can help you there, or if you're already set up, we can still help you, but there's always a member of the team that will be with you. And then that carries on into the group. We have a private Finrev members group, and then that's the best way, to stay on top of any kind of news that happens.
What I recommend is using the resources inside our community to learn more about trend following. Trend following is much easier to live with the more you understand about it. And I understand it very well. And so because I understand it very well, all the things that are annoying about it don't annoy me anymore. I just know that's why I get paid for it. You get paid for taking risk. We have this problem in our society where we associate a drawdown with, like, you picked the wrong stock and the stock went down, so therefore you're stupid and you're an asshole and you made the wrong decisions. That's a bad framing. The correct framing is you get it. You're paid. The drawdown is not a penalty for you fucking up or making the wrong decision. The drawdown is the price that you pay for getting on the ride. And we're on a ride here. The ride is going to be a little bit bumpy, but it's going to get us to where we want to go in 5 years' time. The drawdowns will happen. Anyone who tells you that there's going to be no drawdowns is lying to you. Those drawdowns are the price of admission, and that's how it works. Like you got to fall in love with that process. The worst thing you can do is add more money when you feel great about it, and pull money out when you feel bad about it. That's the worst thing you can do. That's bad. All you got to do is just stay on the ride. And the the way that I tell people about it is it's a roller coaster with a happy ending. It has a few little moments where it's boring and a few moments where it's scary and a few moments where it's absolutely thrilling. And all of those get you to exactly the same point at the end of the ride.
Brilliant. Really brilliant. Well, we've taken up a lot of people's time today. It was kind of 80 minutes now.
Yeah, sorry about that, guys. I do like to bullshit.
You haven't learned much today. You've been pretty good on the math.
Compared to normal. So who wants to do another hour of stochastic calculus? Hey,
Oh,
owners everywhere.
absolutely.
All right, guys. Thank you so much for your time, everyone. Look, yeah, you should book that call and you should join us. Yeah, you should.
Okay. Thanks, everyone.
Thanks,
Goodbye.
everyone.